Three types of investment companies. Out of the three types of investment companies discussed in this video, two are closed-ended and the last is open-ended. Closed-ended, including our first two examples of exchange-traded funds and exchange-traded notes, means that there are a fixed number of shares of the company. Those shares are traded on the over-the-counter market. Those are the oldest types of investment companies that were very popular until the market crash of 1929. Our last example, the mutual fund, is an open-ended investment company, meaning there's no number cap of shares, thus allowing the company to expand nearly infinitely. Exchange-traded funds, or ETFs, are typically a basket of stocks that follow a geographic area, investment style, industry, or the market as a whole. As ETFs are traded on the over-the-counter market, they are subject to the same options as regular corporate shares, such as selling short, calls, puts, etc. ETFs are predominantly unmanaged, so the annual expense tends to be lower than that of actively managed funds. Investors find ETFs' tax benefits to be more appealing than those of mutual funds in regard to capital gains. Investors of ETFs have the ability to decide when to sell funds in order to realize a capital gain or loss, thereby increasing the utility of exchange-traded funds. ETFs were involved only in equity securities until 2002. Since that time, they've expanded to include bond segments, real estate, currencies, gold, and other various commodities. Exchange-traded notes. ETNs are similar to ETFs except for the underlying security. Where the ETF trades in securities with some linked value, ETNs focus on notes or a promise to pay back a debt. ETNs are based on the creditworthiness of the entity backing the promissory note or IOU on which they're based. Otherwise, they're treated the same as ETFs. Mutual funds. The importance of mutual funds to the average investor is irrefutable. In 2018, 45% of households in the United States own mutual funds. By the end of that same year, 29% of U.S. stocks were owned by mutual funds acting as intermediary between households and Wall Street. The popularity of mutual funds is based on a number of factors. Diversification. Diversifying risk down to its lowest likelihood is imperative for a successful portfolio, yet many households do not hold the requisite amount of resources to fully diversify on their own. Most mutual funds add the benefit of instant diversification. Convenience. Owners of mutual funds do not have to perform risk-reward analysis involved in running a balanced and diversified portfolio. By buying into a mutual fund, a household is also acquiring a portfolio manager, so to speak. Extra financial services. Mutual funds can also include some benefits that you would normally find in a large commercial bank, such as some record keeping, tax preparation, limited check writing, handling retirement accounts, and the like. Mutual funds are open-ended investment companies, meaning that there's no set amount of shares that can be purchased, thereby capping the number of investors in any particular investment company. As a matter of fact, the more securities the mutual fund manages, the more money it can make. The number of assets controlled by mutual funds has shown great growth. In 1980, assets owned by these open-ended investment companies totaled $130 billion, and as of 2017, $18 trillion worth of assets were controlled by mutual funds. Now, that doesn't mean that there's no risk involved. As a matter of fact, in 2017, 2009 funds merged and 383 mutual funds were liquidated. You'll always find some level of risk in nearly any investment.